Imagine this. The stock market jumps one day, bonds tumble the next, and the news anchors insist everything is stable. Economists point to signals, but the signals themselves are screaming in opposite directions. You're not imagining it. Financial signals are supposed to tell us the truth about the economy, but more often than not, they contradict each other. And the real kicker? Sometimes the very rules designed to make the system predictable are the reason it isn't. It sounds absurd, but the world of finance is filled with hidden feedback loops, invisible levers, and incentives that almost nobody outside the system fully understands. The result is chaos disguised as information. So why does this happen right now? Because we live in an era where information travels faster than ever, but the systems generating it are older than most modern technology. Economic data like inflation, employment numbers, corporate earnings are collected, interpreted, and published on different timelines. One dataset might be a snapshot from last month, another from last week, and yet another is a projection for the next quarter. By the time we see them all together, they can tell completely opposite stories. Add to that the influence of central banks, global supply chains, and speculative markets, and you get signals that seem almost intentionally confusing. But it's not intentional. It's systemic. At the core, the financial system is a conversation between investors, governments, and institutions conducted in numbers. And like any conversation, it's full of miscommunication. Take bonds versus stocks, for example. Bonds are sensitive to interest rates and long-term growth expectations. Stocks react to earnings and sentiment. So, when the economy slows but inflation rises, bonds might signal caution while stocks look relatively stable. Each signal is correct in its own narrow context, yet they contradict each other when viewed together. This isn't a flaw in the data. It's a flaw in how we interpret it. Humans crave a single story, a clear direction. But the economy rarely provides one. The mechanics are deceptively simple. Every economic indicator is, at its heart, a number produced under assumptions, biases, and imperfect information. Even something as widely cited as GDP is an estimate. The methodology behind unemployment numbers, inflation, and manufacturing output varies. And every adjustment, every seasonal correction, can shift the signal. Layer on top of that global capital flows, currency fluctuations, and political decisions, and you begin to see why signals conflict not just sometimes but constantly. Yet we still expect them to behave like a traffic light. Green, yellow, red. Then there's the role of market expectations, which often contradict the raw data itself. Investors don't just react to numbers. They react to what they think other investors will do in response to those numbers. This feedback loop creates tension between the actual economy and the perceived economy. Sometimes markets move purely on sentiment, even when the data suggests stability. And when two markets, say equities and bonds, interpret the same data differently, it creates the appearance of conflict. In reality, both are logical within their own frameworks. Ironically, the more sophisticated our tools become, the more signals we generate, and the louder the contradictions get. Machine learning, algorithmic trading, and high-frequency strategies all respond to microtrends and subtle shifts in data. What would have been a minor blip for a human analyst now triggers massive moves across multiple markets simultaneously. One algorithm interprets a drop in unemployment as a bullish signal. Another sees it as inflation risk and sells bonds. The result is noise amplified into dramatic swings, making the signals appear even more contradictory. To understand why this matters, consider the stakes. Policymakers, pension funds, corporations, and even average savers base decisions on these signals. Misinterpretation can lead to overconfidence, panic, or costly mistakes. But even when the signals are clear, the speed of modern markets can turn clarity into confusion. A government report might arrive at 8:30 a.m., market reactions begin at 8:31, and by 8:32, prices reflect not the data itself, but the reaction to it. By the time you look at the headline, the signal has already shifted. Then there's the hidden math behind conflicting signals, the lag and amplification built into the system. Consider inflation. Consumer prices rise gradually, but markets price in expectations months in advance. If central banks act too early, they risk choking growth. If they act too late, inflation spirals. Every decision generates new signals, some reinforcing, some contradicting the old ones. The irony is that the system designed to stabilize the economy, interest rates, regulatory interventions, reporting standards, creates exactly the conditions for signals to conflict. What makes it even stranger is the human tendency to overinterpret. Analysts and commentators love to draw narratives from contradictions. Stocks are booming because the economy is strong. Bonds are falling because a crash is coming. Both statements can be true, and both can be false at the same time. The truth lives in context, nuance, and timing. And most of the time, we don't have enough of any of those. Zooming out, the bigger picture emerges. Financial signals are a mirror, not a map. They reflect the complexity of interconnected markets, human psychology, and imperfect measurement. They don't tell us what will happen. They tell us what the system believes is happening right now. And when belief diverges between traders, governments, or algorithms, the signals conflict. The discomfort you feel watching contradictory headlines isn't confusion on your part. It's the economy being honest about its own complexity. So what's the takeaway? There's no single number, report, or market that can give us the final answer. The signals will continue to contradict, to surprise, to unsettle. And perhaps the most important lesson is to get comfortable with the contradiction itself. Because in a world where every financial signal is part of a massive, interwoven system, clarity comes not from certainty, but from understanding the uncertainty. And that uncertainty is exactly what keeps the markets moving and keeps us watching. In the end, the uncomfortable truth is simple. Financial signals will always conflict, not because someone is lying, and not because the system is broken, but because the system is alive. Complex, adaptive, unpredictable, and entirely human. And maybe, just maybe, the question we should be asking isn't which signal to follow, but how to make sense of a world designed to never give a single answer.